13F filings rolling in amid what has been a hard knock year for hedge funds. Leslie Picker's back in the newsroom with more on why it's been hard out there for the funds. Leslie.
Hey, Melissa, that's right. We're seeing a lot of movement in bank stocks as 13F filings trickle out. Buffett taking a new stake in JP Morgan and adding to his position in Bank of America and Goldman Sachs. Tiger Management adding some new calls on Citi, Bank of America, and JP Morgan. Apple was also a popular add in the quarter. Tiger Global's Chase Coleman took a new stake, as did Appaloosa's David Tepper, buying 100,000 shares worth about $20 million. Now, these numbers are as of September 30th. Notable, though, because they show how hedge funds were positioned before October, which was a very tough month for them. Energy and technology funds down about 8%. And 5% respectively, and activist funds were down an average of 5.4% for the month. Now, one exception is Pershing Square's Bill Ackman. His fund was up 8.5% in the quarter, and he said in a third quarter investor call earlier today that his winning positions, ADP, Starbucks, and Chipotle, were actually helpful to his portfolio because they have such little hedge fund ownership.
It's sort of bet against the hedge funds has been a good trade this year, and hedge funds tend to be shorter term in nature. Hedge fund industry's had a poor year. Apparently most funds down for the year. People facing significant redemptions, forced sellers. And so we think that is a interesting sort of factor.
Now, tomorrow is the deadline for many investors and hedge funds to give their notices about whether or not they want to redeem. We're already seeing many predictions in the industry for a wave of closure as a result of this recent performance, Melissa.
Leslie, is Bill characterized in the tables as an activist fund? Because those positions were passive positions.
Point. Exactly. He is still characterized as an activist fund. That's what his fundraising materials indicate. But he did note some investor questions surrounding his active versus passive positioning and some of the recent holdings that he has. And he said that just because you're not seeing us in the media on CNBC, he mentioned CNBC by name, in the newspaper rattling the tables, doesn't mean that we're not doing active positioning and having those conversations behind the scene. For what it's worth.
All right. Leslie, thank you. Leslie Picker back at headquarters. Well, Marc Levine is the chairman of the Illinois State Board of Investment. He eliminated hedge funds from portfolios under his management, saying they were destroying enormous value. Marc joins us now. Marc, that was a while ago. So how has it been in terms of your performance not having hedge funds in there?
Well, remember, we took out the hedge fund category, but we retained some great managers. So we moved into our equity book. And those managers are actually doing quite well. And those are names like SRS and Tiger Global and Viking, those sorts of names, TCI, Ichigo, right? So they're doing quite well. Now, we redeemed about 70 hedge funds. And now some of them, because of it takes like years to actually get out of them, they've actually been dragging our performance down. So we're just kind of waiting to sort of get rid of them. And that'll happen fairly soon. And that's sort of where we want to be.
What is your investment committee saying these days about what the market environment is and how you want to be positioned overall in terms of your allocations?
Yeah, so I think generally we're bullish. We're not making any dramatic changes to the allocation. The one place where I'm a bit nervous is in the corporate lending space, where they basically had the leverage corporate lending space, where they basically had a free pass in 2008 because all that liquidity came in to save the banks, save all the garbage mortgage derivatives, and that enabled that entire industry to refinance. And I'm worried that we're sort of really long in the tooth. You think we're long in the tooth on 9 years going into in an economic recovery? We're probably about 20 years since leveraged corporate paper has really faced a test. And so we're making some moves in the portfolio along those lines.
Let me ask you back to the hedge fund. Good call, first of all. But let me ask you something. So when markets are straight up, that's a tough time for hedge funds. But if flattish like this, they should really do well, which isn't happening. What would it take for you to rethink that position? Is it pricing? Is it years of outperformance? What would it take?
Right. So when we think about hedge funds, we divide it into the two groups. There's the derivative books and the stock pickers. The derivative books have been just awful. I mean, they've generated sub 2% returns 3 years, 5 years. They just don't make any sense. They're piles of derivatives. They sell themselves as like diversifiers, which means you should pay them about 20 basis points, right? That's what we pay our bond guys, who are the real diversifiers. So that there's no appetite for that. And again, on the stock picker side, okay, We like a few of them. There's about 10,000 hedge funds, about half of them are stock pickers, and we think there's about 50 or 100 good ones. We have 10 in our portfolio. The good ones are really hard to get into. They're all closed. All the names I gave you, those are closed funds, and so we're very happy with our portfolio. And it's actually not, and the performance has been like multi-100 basis points of alpha. Now, it's really, the great performance really isn't me or us. We've actually had a relationship with a firm called Rock Creek. Sonny Beschloss has a terrific team down there. They got us in these things years and years ago, and we're really getting the benefit for that right now.
So, Mark, I'm curious. It sounds like what you're paying for, whether it's a 2 and 20 hedge fund structure or not, is really just a good manager. And it doesn't matter what wrapper it's in. So it's not so much hedge funds, it's just that there maybe aren't that many good managers out there.
That is everything. That's exactly what our philosophy is. A hedge fund structure is a negative. We don't like a hedge fund structure, but we're willing to deal with it if we can get a great manager. So of those 10,000 hedge funds out there, there might be 100 great managers. And I come on shows like this and sort of, my biggest fans are actually those 100 guys, because they're getting really taken advantage of by the other 9,900 that are sort of trading off of the great returns of the great managers because they happen to be structured the same, which is completely, irrelevant.
Mark, great to see you. Thanks for coming by. We appreciate it.
Thank you, Melissa.
Marc Levine of the state of Illinois. Guy Adami, where do you want to go in terms of some of the 13F filings that we've heard about?
I think Buffett initiated a position in J.P. Morgan, right?
Yes.
I think that to me is the most. There are a lot of interesting ones. To me, that's the most interesting. Obviously, J.P. Morgan's had a tremendous run and probably the most expensive on valuation, or one of the most expensive. You have to ask yourself, he's a value investor, initiating a position in a stock that he still sees value in. I think that sort of augurs well for JPM.